focus. Ideate, innovate, enable. Reliance Mutual Fund and CNBC TV 18 present Mutual Fund Day, Mission Prosperity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Tax planning, an extremely important element of personal finance, but one that typically gets relegated to right the end of the financial year because of our daily hustle and bustle in our lives. And that's when we end up making certain mistakes, end up taking certain hasty decisions, and making investments which might not mean the best in terms of our wealth generation and money management aims. So therefore, today we have for you Reliance Mutual Fund and CNBC TV 18 presenting Live Hacks, a special show where we will talk about tax planning in great detail. Joining in to do that, Ashwini Kumar, Senior Fund Manager at Reliance Nippon Life Asset Management, and Feroz Aziz, Deputy CEO of Anand Rathi Private Wealth Management. Gentlemen, thank you so much for being with us on the show. You will, of course, also have to field a lot of the queries that we're going to get from our lovely live audience. But let me start with some initial views here. When we talk about tax planning, typically the first thing, Ashwin, that comes to mind is Section 80C. That's what we have always known, and that's what we immediately rush to. But what is your approach when you're looking at personal wealth, personal money and taxation?
See, basically there are a lot of options. You have PPF, you have other options, you have ELSS, you have insurance, which can give you these benefits. But when it comes to ELSS schemes, what it provides you is possibility of capital appreciation over a period of time. And also there are options of dividend options, there are growth options. But fundamentally speaking, in India, which is a growth economy, equity markets over a longer period of time have the possibility of generating GDP plus inflation kind of returns over a very long period of time. And this instrument provides you with the opportunity of participating in that growth. This is what ELSS is all about.
Absolutely. Well, we'll talk more about it as we go along. But let's take one step back. Feroz, your thoughts on this? Tax planning typically is the first motivation for a lot of young people, particularly young investors, to get into some sort of discipline, because otherwise, you'll see that much go off from your salary. So what is the first piece of advice that you would give out to young people as they look at it for the first time?
See, I think, of course, like you rightly pointed out, Ravi, tax planning becomes a very important prime requisite and a motivation for somebody to start saving. But I think that's an incorrect way of looking at savings, investments, and planning for your goals, which are a mandatory thing from a financial perspective. So I think that can't be the prime requisite. It has to be a second or the tertiary kind of an objective. The primary objective is to be that how is different instruments going to help you meet your goals. And in that rush, like you rightly pointed out, people do it in the fag end of the financial year to just save some tax. That automatically becomes the more important driver of that investment. That's certainly a biggest mistake one could do. So young people generally get into this trap. So firstly, plan your finances, get your financial planning in terms of goal setting right, get your asset allocation right, and then comes the product selection, and then comes the tax planning. And of course, if there's a motivation in terms of exemption on your income tax, that's definitely a good extra benefit to have, but that can't be the primary one.
Oh, absolutely. So let's quickly go over the options, because for many years, I mean, this ATC limit has been fairly bundled up in terms of the income which is going to be exempt from taxation thanks to this segment. So quickly run us through the options that do exist here.
See, there are predominantly debt options. And this seems to be the only pure equity option. So that's why this becomes a little different than the rest of them. You have PPF, you have National Post Savings Certificates, you have FDs which have a 5-year lock-in, which have a tax benefit. Then you have insurance, ULIP plans, endowments, and then you have something which stands out because that's a pure play equity, like Ashwini was mentioning, that can give you a far larger growth potential. Of course, there are risks associated with it, but because you have lock-ins and longer time frames to invest, that becomes a good standout kind of an investment from an asset allocation standpoint.
Sure. So Ashwini, let's get your thoughts. I mean, ELSS also has been a bit of a stepping stone for a whole generation of people who've then become more permanent equity investors.
Yeah.
What would you say would be the key benefits of the product the way it's designed today?
See, one, it is giving the fund manager the time frame to look at 3 years and beyond. So fundamentally speaking, his portfolio construction also looks at a much longer time frame. That's one. Second, the investor also has decided that he cannot move out once he is investing for the first 3 years. He doesn't have the option. So it also gives him opportunity to look at equity from a 3-year standpoint, and that is where, because in equities it is the time which is making the money. If you keep equities for a longer period of time, then the probability of making money goes on increasing. So unlike an open-ended product where in a declining market scenario or a scenario where there is big correction, there is a probability that he might move out money. Whereas in this case, he has to necessarily keep the money invested in for the 3-year time frame. And it is quite possible that at the end of 3 years, he can just roll it over, he can continue to be in it. Maybe he doesn't have the tax benefit, but because the appreciation doesn't come exactly in the 3rd year, for example, he investing in 1st December 2017, then what the markets are in December 2020, that will determine the NAV of that product. But if he continues to stay invested, it gives him the habit of looking at equity from a longer term time frame.
Sure.
And that is the crux of it. In my opinion.
So does that significantly mitigate the risk that's also associated with equity? The fact that 3 years is the minimum that you will be locked in.
Yeah, see, it cannot protect the capital always. I mean, the way things are designed. For example, if somebody came in 2005 and then in 2008, in a very big reset, the markets went down very sharply in a 100-year event.
Yeah.
It is maybe he can lose money at that point in time. But on a normal market scenario where there are normal corrections happening, it is very much possible that his probability of losing money is relatively less because of a longer period of time he is invested in.
Would you agree, Feroz? What about the risk element of ELSS as a product?
See, I think like Ashwini rightly pointed out, it removes the emotions when you're managing your money. That becomes the biggest deterrent for a person to make money. Being greedy or fearful actually is detrimental to your investments. So that's point one. Point two, the 3-year time frame, of course, significantly reduces the odds of losing money. But the optimal time frame historically seen is 5 to 6 years, brings down the capital risk to negligible in a mutual fund. In the index, it has happened that in a 10-year time frame, also there has been minus 2% return historically on Nifties and Sensex. But on mutual funds, a 6 to 7 year time frame brings down your probability to losing capital to negligible extent, because there's also a professional trying to add value to you and try and do stock picking, which you have outsourced to a person, and he tries to protect your capital. I think 5 to 6 years is a good time frame. 3 years definitely significantly lower odds than a 1 year maybe.
And how would it compare looking at some of the other options? Ashwini, what would you say when people are actually making a choice between a lot of the fixed income options that are under that ATC limit, whether it's your PPF, whether it's the NSE savings certificates, etc., and ELSS? So what do you think really stands apart? Is it just the sheer power of the asset class, you'd say?
See, basically there the capital is protected. So that fear is not there in PPF or a PF. Here you have substantial upside if you have a 5-10 year kind of time frame. When I use the word substantial, it is not to quantify a very big number, but relative to what you could get in PPF.
Sure.
And it is protected, as Feroz pointed out, by diversification of the portfolio.
Okay. Well, on that note, we will take a quick break, but the conversation continues on the other side. How exactly do you need to go about making that ELSS investment, the different options within the equity-linked savings schemes platform? We will discuss all of that after the break.
Reliance Mutual Fund and CNBC TV 18 present Mutual Fund Day, Mission Prosperity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back. You are watching Life Hacks, and the topic that we are discussing this time around is taxation and how perhaps ELSS, equity-linked saving schemes, could be a good way to not just save tax but also start creating wealth over the longer term. So, Feroz, talking about marrying ELSS and its tax advantage with a certain goal, because you said the first requirement of a PF plan is setting goals. So, you might be making an ELSS investment, but how do you decide what goal that is for?
See, I think ELSS, to my mind, has to be a portion set aside for retirement. Then your worries with respect to equity are significantly lower because retirement generally is far away. Point one. Point two, when you're younger, your portions in ELSS could be larger because your employee provident fund portion of the ATC limit is automatically going to be lower because your starting salaries are going to be lower. So I think marrying ELSS to a retirement plan or an education loan or education purpose for your child, which is 10 years away, is a very good strategy by the nature of it having equity in it. Like Ashwini is saying, longer the period, the better you are. So ELSS should ideally be a portion to your retirement or to a child's education, for example, 10-15 years away. Then automatically equity will make sense. For retirement, generally looking at the contemporary situation, having 70 to 80% of one's money in equity is a good strategy. So if 70-80% is anyways going to be skewed to equity, then there is space for ELSS to fit in the big scheme of things.
Okay, fair enough. And the earlier the better, you would say it's a product that works well for younger individuals, young investors?
Yes, I think power of compounding kicks in, because if you're younger, every 5 years, actually if you compound money at 12-13%, actually every 5 years advancement doubles the corpus at retirement. So younger the better, and the penalty for delaying it is going to be far more than a person can envisage, because power of compounding never fails to surprise me when I put some math around it.
Okay, fair enough. Actually, then let's talk about the sort of options that ELSS gives. There's the growth option. There is the option in which you can sort of opt for a dividend. What do you think makes sense?
See, somebody who wants to invest lump sum and for a longer period of time, he can invest in the growth plan. Somebody who is seeking, let's say, dividends in a quarter, for example, he can opt for dividend plans. But the thing is that in dividend plan, you are foregoing the potential of the money which is you are taking out by way of dividend. Because if, let's say, NAV is 13 rupees and you give 1 rupee dividend, then only 12 is working for you. So you should very carefully weigh whether actually you need it or not. So that is very important. Also, people should start very early. Let's say they should start thinking about it in the month of April rather than coming in at March, because many times we have seen in the last 15, 20 years or 30 years, if you take out the data, normally speaking, by March as compared to April, markets are relatively higher. So why should they lose that appreciation? If they are decided about this equity option through ELSS plan, they can start in the beginning, or if not that, they can invest via SIPs throughout the year. For 12 SIPs, that is possible.
All right, so before we throw it open to the audience, let me ask you any final piece of advice.
If you take a dividend payout option, you always have this option to choose between different funds. If the same fund is doing well, you can reinvest it back in the fund, but the ball will be in your court. Because if it's a 3-year lock-in, you should have the agility to move around between funds. So dividend payout with an agility and a vigilance to reinvest that money is also a very important aspect.
Absolutely. Well, on that note, let's throw open the conversation, the discussion to the audience as well, and let's see if we have any questions. If anyone has any doubts, any queries, you are free to ask.
Normally nowadays we hear it from everywhere that ELSS investments are exempt. How are they exempt?
See, basically they are exempt. If you invest 150,000 rupees, then 46,500 odd becomes an exempt. And at the end of 3 years, if let's say you start at 10 rupees NAV and it is, let's say, 20 rupees or 16 rupees, then all that capital appreciation also is exempt for you at the end of the you don't have to pay any taxes there.
So it's exempt when you are sort of investing, exempt during the period in which the product life cycle is continuing, and completely exempt upon taxation. So this is one of those gem of a products, I guess, from a taxation standpoint. Would you agree, Feroz?
Absolutely, it couldn't get any better because your last bit, there are some investments which come under the ATC where when you withdraw your money, the maturity amount is also taxed, like a pension scheme. You're compulsorily going to buy an annuity with your pension scheme, which again falls under ATC benefit or the list. So exempt, your returns are exempt, your initial, there's a tax exemption when you invest, and lastly your maturity comes to you completely tax free, unlike some of the other instruments.
Including fixed deposits. I mean, even there, at the last mile, you ultimately end up paying tax. Okay, let's see if there are any questions.
Hey, hi. So, if I opt for the dividend withdrawal option, so will that be taxed as well?
No, fortunately, as we stand today, equity as an asset class is got preferential treatment with respect to taxation. And so dividends are absolutely tax-free. There's something called dividend distribution tax, which ideally gets levied on some other kinds of schemes, which are debt schemes or hybrid schemes in certain cases. So equity dividend distribution tax, which is optically not visible to an investor, is also zero, and there is no tax whatsoever. If you have invested, even if you got a tax dividend the next day, that dividend is tax free for you.
Okay. Any other questions?
So what are the pros and cons of ELSS dividend and growth options?
See, fundamentally, what is your requirement? Is it the dividend or the income which you require in a quarter or in a year interim, or you are happy with investing for the long term? But as I said, if you invest in a scheme at 10 rupees NAV, its NAV becomes 12 rupees at the end of quarter one. If I pay out 50 paisa dividend out of it, then only 11.5 rupees is working for you. 50 paisa you have already received. So therefore, if you are a long-term investor, if you don't need that money, then you can stay invested for longer term via a growth plan. That would be my advice.
Any other query?
Hi. Like we design brands in the brand strategy part for our clients. So as per the new budget, what do you think would be the change in the tax structure? How will it affect our brand's ELSS structure?
When you've invested in an equity-linked savings scheme, you're locked in for 3 years, which means that the finance ministry has 3 budgets to give you before your money is with you. If there are any tax changes, will that apply to your investments already made? The answer is yes. So if equity long-term is tax-free today, and if it is tax-free at the end, then you get your money tax-free. So as it stands, insurance policies lock in taxation in most situations. Mutual funds don't lock in taxation. Taxation is subject to the tax laws applicable during redemption, not at purchase. So if there is any tax change during this 3-year period, will you be subject to the tax change, adverse or beneficial? The answer is yes.
All right. Thank you very much, audience, for your time. And of course, thanks to both of you for enlightening us with those concepts around the equity-linked saving schemes. That's it on this special. Thank you for watching.
Reliance Mutual Fund and CNBC TV 18 present Mutual Fund Day, Mission Prosperity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.